Jonathan and I have worked together and invested together for over 30 years. We met fresh out of university as strategy consultants at Bain & Company, and then went on to set up and build a media business and a software business. Initially, in the 1990s, we built those businesses organically, but then from 2000 onwards, we started to acquire other private businesses.
So during that period, we looked at over 500 companies that were available for sale. We made 30 acquisitions, and the returns were very good for shareholders. But we always felt that we could apply the processes that we used, the quality criteria, the valuation approach, and the due diligence approach to the public markets. And we wanted to do that because the public markets have a much wider selection of companies to look at, and the transaction costs are so much lower of investing in public companies. So in 2008, with our own money and the backing of a family office that still invested with us, we started Metropolis Capital. And that background of building, buying and running businesses has stayed with us. So we think about all of our investments as a business owner. We think very long term, and we use the same quality assessment, valuation approach and due diligence that we used when buying private companies. In terms of culture, we're a small investment team. We're very enthusiastic about understanding how different businesses work. We're very interested and curious in what makes businesses successful, and this really makes us enjoy our jobs, and that's the reason that we're doing it.
We've always only managed one strategy since the inception in 2008, and our investors include institutional pension funds, private clients, discretionary wealth managers, charities, endowments and family offices.
So we're value investors, which means that we invest in companies only when they're trading at a significant discount to the future value of their cash flows. And the critical thing is, for us, is to be able to estimate what those future cash flows are going to be. And this means that a company has to reach a certain quality standard that we set. And over the years, only 8% of the companies we've looked at meet this threshold. So, for example, we avoid companies with high leverage, we avoid companies subject to very big disruption threats from technology change or increases in competition. For those companies that meet the quality threshold, we look for a substantial discount to the market price before we invest. That gives us a margin of safety in case something goes wrong, and also gives us the first part of our returns. Gradually over time, if a company keeps generating cash, it becomes re-rated by the market and its valuation increases significantly. So, for example, we invested in Microsoft in 2010. At that time, it was very undervalued by the market, trading on single-digit multiples, because the market was concerned that the launch of the iPad was going to seriously damage Microsoft's business. Over time, Microsoft kept generating cash. Gradually, a new narrative came along, and it was re-rated. The share price went up. It reached our view of intrinsic value, and we sold it. And that's something that we always do. When something hits intrinsic value, we sell and we reinvest in other companies where there's a margin of safety. And then finally, because all of the companies that we invest in pay out only a proportion of their profits and dividends, if any, we look very hard at the way management allocate capital, particularly to acquisitions, because how they treat the capital they retain in the business is really critical to getting a good investment return. We think that having run businesses, made acquisitions, we're in a good position to be able to assess management on this front.
As Jonathan mentioned, we struggle to value a business unless we can be absolutely certain that the cash flows are sustainable. To answer that, we've developed our own proprietary quality framework, which assesses that sustainability looking along different attributes such as scale advantage and customer stickiness. Only 8% of the businesses we look at pass that quality threshold. And of those that do, the majority are too expensive. So we simply put these onto our watch list, which is like a bench of substitutes waiting to come into the portfolio. The portfolio itself being made up of those companies that have passed our quality threshold but provide us the greatest margin of safety. So how do we get to those businesses? Well, we have a 4-stage process. And the majority of the heavy lifting of that process happens in stage 4, which is when we do very detailed bottom-up valuation, breaking the business up into different revenue streams, different margin drivers, and thinking very hard about the long-term dynamics of the business. We also go out and do the kind of due diligence that we did when we were buying whole businesses. This is kind of scuttlebutt type research where we talk to players in the market. A good example was when we invested in Curate. Curate is the owner of QVC Home Shopping, the channels that you see on television. Now, the market narrative that was driving a very low PE for this company when we invested in it was that it was going to get killed by Amazon. We reached out and spoke to over half a dozen of the suppliers who sell their products on QVC. And what we consistently learned was how much they valued QVC as a channel for the distribution of their products. And the reason for that was that QVC helped them to build a narrative, helped them to build the brand of around their product, something that was not really possible through Amazon. And the result of it was that those suppliers were prepared to share more of the economics with QVC, which QVC then passed on to its customer base. We were able to get comfortable that that was true by doing price checks on over 150 products on the QVC Home Shopping channel and comparing it to Amazon. And what we found is that in 80% of cases, QVC was either cheaper or actually exclusive. The product wasn't even available on Amazon.
Because we're assessing the long-term sustainability of a company's cash flows, consideration of ESG issues has always been integral to our approach. Our ESG framework is one of the key ways that we assess some of the disruptive threats that impact any business. This could be regulatory changes, carbon taxes, many other things. So, for example, a few years ago, we did not invest in William Hill because we were concerned that fixed odds betting terminals were likely to be subject to regulatory change. A few years later, this did happen. The maximum bet was reduced from £100 to £2, and that had a big impact on their profits. But ESG is also a source of opportunity in the portfolio. So, for example, Texas Instruments benefits significantly from the growth of electric vehicles because electric vehicles have 3 times as many analog chips as conventional cars. Another company in the portfolio, Berkshire Hathaway, has developed the second largest wind turbine operating business in America.
In terms of process, we evaluate ESG risk and opportunity at every stage of our investment process. This starts in stage 1 when we screen for those industries which we specifically exclude. In stage 2, which is typically a 4 to 8 hour exercise conducted by the analyst using templates, we bring in data from third-party sources and they use their own analysis to enhance that. And that research helps to inform the discussions we then have in stages 3 and 4 with the potential investee companies.
Managing concentrated portfolios has always been central to our strategy since we started 13 years ago. We've always invested in a portfolio between 15 and 25 quality global companies, which we know extremely well. And we believe that if our portfolio was any larger than this, we would actually be diluting our best ideas with those ideas that we were less convinced about and where there was a smaller margin of safety.
Jonathan and I are the co-founders and co-portfolio managers for the strategy. We have responsibility for the day-to-day decisions on every single trade that we make for the portfolio, and we'll be doing so for Alliance Trust.
Simon and my background is quite unusual for fund managers. We started as Bain strategy consultants, which taught us a very analytical approach to understanding businesses and to helping these leading global businesses to improve their competitive positions. We then had 16 years of experience building, buying and running operating businesses in the real world. And this taught us a lot of lessons about how businesses work and ingrained the long-term thinking in our approach. So as a result, we think like business owners and we see stock market volatility as an opportunity rather than a threat. Our experience making acquisitions also led us to develop a very detailed private equity style approach to due diligence, which I think is quite unusual in the public market world.
In addition, the entire organisation, from the ops team through the investment team, compliance and client services, are focused on helping Jonathan and me deliver exceptional value to our clients through one single strategy. And we're all in. We've invested all of our financial assets in our fund, which means that we're investing right alongside our clients. Since the inception of the strategy in 2008, we've delivered against our target of beating inflation by 10%, which has also meant that we've outperformed the global benchmarks. Our focus on quality and valuation has also tended to mean that we've outperformed in down markets. If you look at the quarters since we launched the mutual fund in 2011, there have been 8 quarters in which the benchmark was down, and we've outperformed in 7 of them. The 2020 crisis of March last year gave us an amazing opportunity to buy companies off our watch list that were trading at significant discounts to our view of intrinsic value. And the trading decisions that we took at that time have helped us to deliver a pretty solid performance over the last 12 months. In that period from the 31st of March 2020, the mutual fund has outperformed its global benchmark by 6%. We invested in Admiral in 2012 when we became convinced that it was going to be the long-term winner in the UK car insurance market. Car insurance is not an industry which is typically found in the portfolios of quality-oriented investors because the customers are fickle and very price sensitive. And this has only been exacerbated by the growth of online price comparison sites. But in fact, it's this trait which actually makes Admiral a good business, because Admiral is the low-cost provider in the market. And the more price sensitive the customers are, the more quickly it can gain market share. Our conviction in Admiral's ability to use its cost advantage to gain market share has played out very well. It's become the market leader in the UK and has started to build very solid positions in Spain, Italy and France. We think it's a good example of a type of business that we invest in, that we call golden nuggets in muddy waters. So these are good, solid businesses that earn good returns on capital, but in industries which typically struggle to offer that for most of its competitors. The position has done very well for us. It's earned over 18% per annum over the 8 years that we've held it.
So we do not look to invest on a thematic basis for the simple reason that themes can change so quickly from time to time. We're looking really to invest in companies for the long term which have proven themselves in past economic situations which have been very different and which will do well in future situations which might be quite different. In fact, sometimes a theme can create an opportunity to buy a business because it weighs very heavily on a stock. So I gave the example of Microsoft earlier. Another example from 2012, when we looked at Cisco, we saw that it was trading on a very low multiple. And the reason is because the market was concerned that the intelligence in internet switches would move to the software layer and that Cisco would be left making essentially commoditized boxes. We interviewed over a dozen people that buy Cisco's equipment globally, and we reached the conclusion that this was a theoretical rather than a practical risk. So as a result, we were confident to invest in the stock. In fact, over the period since we've owned it, the margins that Cisco makes on its switches have not gone down, they've gone up. And we've made very good returns on the investment. So having said that, there is one very significant long-term trend that we see, which we're very mindful of. And this is that businesses in general, and large public companies in particular, are now expected to do far more than to make as much money as possible while complying with the letter of the law. They really have to behave in a way which makes them good corporate citizens and good examples to the world. So they have to go beyond, over and above, what the law suggests. So, for example, a company which is cutting corners in its supply chain, or in its labour relations, or as regards gender pay, or as regards greenhouse emissions, will find itself in the crosshairs of media and social media attention. And that will be very damaging for its brand and indeed for its performance, its share price performance.